What about the economic data? The latest GDP reading showing that spending continues to surge despite the higher rates. The economy expanding by 4.9% over the summer, but a pullback may be on the way going into the holiday season, at least according to JP Morgan's chairman and CEO Jamie Dimon. Take a listen to what he told Yahoo Finance yesterday.
If this was the average checking account and make believe it's all one consumer, all that money, at one point they had multiples of what they had pre-COVID. That money is being spent down. If you look at that, what I just said, but you look at the lower, there are different ways of looking at it. It's hard to tell, and some inflation adjusts and some don't. But it looks like the lower, call it the third, is back to where it was pre-COVID. They don't have excess savings anymore. And that the middle class is getting close to zero, no excess savings, but they still have jobs and wages are going up. And then obviously wealthy people still have excess and stuff like that. We've seen that number coming down. And, as a matter of fact, I saw 3 forecasts the other day. One said, all from JP Morgan. One said it's going to come down by the end of by the first quarter next year. One was third quarter next year. One was the end of next year. Because, like I said, there are a lot of different ways to measure it.
Let's bring in Veronica Clark, Citi economist. Veronica, good to talk to you today. You heard Jamie Dimon there talk about sort of that savings getting chipped away from the consumer broadly. Is that what you're starting to see?
Yeah. I mean, we certainly look at those excess savings measures. What I wish we had data on was the liquid savings in people's bank accounts, because some of these excess savings measures, it's really just looking at the difference between income and consumption. And we absolutely have seen consumption stay strong, but it's also not going to capture anything that's gone to a down payment for a home, anything that's been used to pay down debts. So it's probably not that savings is really liquid and going to support consumption much longer. It does tell you that the consumer is in a much healthier place, though, relative to pre-pandemic.
And Veronica, I don't know if you heard, I was just talking to Akiko. When we talk about the consumer, of course, there's different consumers, right? The lower income, middle income, the affluent. As you look at those different kinds of consumers, how are they holding up? What are the differences between those three? I don't know if you heard Jamie Dimon there. He's seeing some real differences in terms of their savings.
Right. We also don't have great disaggregate data on some of the aggregate income and spending data that we have. But it does seem like maybe more of that excess savings, if there's any still left, it is probably more concentrated in higher income individuals. Maybe lower income have used up some of that excess savings. But I think everyone we saw even low wage sectors, those were where we saw the really strong initial job growth initially coming out of the pandemic. So the median consumer, I think, is still pretty healthy.
Let me ask you, Veronica, there's been some research that I've seen too showing that really it's kind of the affluent now really carrying the baton forward. As you noted, it's kind of getting more concentrated higher up on the socioeconomic ladder. Is that a risk for the U.S. economy if we're kind of putting all our eggs in one basket there?
Yeah, I mean, I wouldn't say that it's just, affluent people supporting the economy, I don't think. I mean, we do have, aggregate consumption, aggregate incomes that are still rising. And that does mean I think the median, consumer is still pretty healthy. And I do wonder, we did see, some layoffs earlier this year, some loosening of labor markets like in tech or finance, those relatively higher paid sectors, maybe having more of the excess savings in those higher paid sectors. Those people were able to support, consumption for longer as they were maybe losing jobs. So it does, probably help support things overall. But I think the average person is still pretty well off.
Veronica, the resilience of the consumer is something that Fed Chair Jay Powell's been asked about before. At what point do we start to see that monetary policy trickle down? There's an argument to be made that, look, if you're looking at housing, something like that consumers broadly, at least those homeowners, are locked in on those lower rates, which is why we haven't necessarily seen sort of that direct impact. At what point do we start to see it? What does that lag factor look like as you view it?
Yeah, definitely. I mean, we did see, housing activity fall in 2022. It's people are not going to go buy a new home, if mortgage rates are rising. But yeah, for most people, if you've locked in a low rate, 3 or 4%, yeah, you're feeling pretty good. Most people are not going to be sensitive to changes in rates. Businesses will still be, eventually, businesses will face higher borrowing costs. Over a long period of time, people will, have to sell their homes and face higher mortgage rates. But until something really loosens, breaks the labor market, yeah, the consumer is probably okay. We would be worried though at some point higher rates are going to weigh on investment, weigh on business activity, and that could mean layoffs, and that's down the road.
And Veronica, you mentioned the labor market. I just want to dig into that with you. Obviously, we got the big jobs report on Friday. It's been sturdy, the labor market, right, Veronica? We've got sub 4% unemployment. Wages are rising. I'm interested to get your take. What do you expect on Friday, but also just looking in the quarters ahead? Do you think the labor market stays sturdy? Does it start cooling? What do you think?
Yeah, it's been remarkably resilient. And that is really what is supporting activity now. That's what's supporting strong consumption. Until you see the labor market changing, I expect you're going to still run pretty solid GDP growth. We're expecting 160,000 tomorrow. This October number, it's going to be a bit hard to dissect. We will probably have impacts from the auto strike in this number. That'll probably weigh on employment by maybe around 30K or so. So we'll be looking at some of the details are more important this month. But without that strike impact, it's still a really healthy pace of job growth. It probably doesn't last. You probably do see some slowing at some point. And we're watching data like, initial jobless claims, for maybe a leading indicator of that happening. And maybe that, can happen, as we're getting into next year, but near term, we're not seeing the signs of that.